Good morning, everyone. Welcome back to the Schwab YouTube coaching channel. It's our Monday edition of Trader Talk in today's market, and I am your host, Kevin Horner. I want to thank you all for being here, joining us on this fine Monday. I am joined today by my friend, Mr. Jeffrey Abelo, stepping in for our fellow colleague, Michael Bruskof, dealing with a little bit of snow out there in the New York City area. Good morning, Jeffrey. I'm gathering, not getting any snow out there in your neck of the woods.
No, it's beautiful outside. I'm in Arizona this morning. It's gorgeous. I remember I was talking with Bruskof last night, and he's like, "Hey, it looks like I might not be able to even make it into work because of what's happening. Would you be able to cover it?" Absolutely. I always love the opportunity. But I was realizing, Kevin, I have never once, having grown up in Arizona, experienced a snow day. So I've never had that joy of, can't go to work or school this morning. It's always you show up, you got to make it happen. So
Yeah.
I hope it gets a little bit of respite from that snow.
Well, it is something special, I will admit. The ever excitable snow day, as it were. Don't seem to get them quite as much as we used to out here in Colorado, but yeah, quite a great way to wake up some mornings, that's for sure. Hey, everybody, today we're also joined by Brent Moores in the chat. You can say hey to Brent. He'll keep an eye on questions and comments for Jeffrey and me. We'll do the same, of course, because we want to hear from you. I know there's a lot of questions about the broad market. We've got plenty of uncertainty once more all of a sudden in this place. So we're going to try and touch on a number of key topics for you today, but feel free to post for the duration of the show in the chat. Remember to follow Brent and me specifically on X, Brent Moores CS and Kevin Horner CS. Definitely the best way to meet up with us when we are not hosting for you here. Now, let's get to our disclosures, and then we'll dive into the charts. Please remember that our discussion is exclusively for your information and your education. We do not make recommendations. We do not endorse any specific approach to trading the market. We will discuss technical analysis, meaning simply as we evaluate the areas of the market here on the charts, we're going to bring those concepts of technical analysis into our discussion. Remember, these are merely ideas, concepts traders may choose to employ. Technical analysis should not be the sole means of your decision making, though we think it can be a piece of your overall puzzle. Now, as far as our agenda, we're going to follow our traditional approach here for this class, which is a top-down review of the market. So we're going to start with our broadest indices, the S&P 500, then we'll move into the NASDAQ 100, the Russell 2000, semiconductors, perhaps transports, sectors that are moving around, and plenty of other headline groups. So with that, let's dive right on in here, Jeff. As I mentioned, we had a little bit of a lift in the volatility of the broad market here. Last week, we had the administration's tariff decision from the Supreme Court knocked those down, and then the administration and the president immediately thereafter came out and kind of re-upped the ante, as it were, to tariffs. So once more, the tariff word, the conversation is back on the table for us. Jeff, is there more that we can take from that than maybe just an expectation for more volatility here?
I think that's it right there. Probably expect more volatility. And then I think a lot of us have gotten used to this. It's a bit of a yawn at this situation. Oh, all right, more tariff stuff. So I think we've got 150 days of this level, and I think it works out to be somewhere around 13.6% if I was reading a study produced by Yale a little earlier this morning. So yeah, expect volatility to pick up. But Kevin, I think what we're seeing from a lot of angles in the market, it's a very fast reaction, and then it gets back down to normal much quicker than we've seen in the past. Think about if something like this were to happen in the 90s, this would be oh my gosh, this would go on for the entire presidential election cycle. Now what we're seeing is, well, this will happen today, but let's see what he says tomorrow. So a very quick reaction. Wouldn't be surprised, though, if the volatility comes back down in a very fast way. Ultimately, we'll see what the market has in store.
Yeah, and you know, the truth is, Jeff, with the headline risk, it's not like this was going to be a quiet week anyway. We are going to be hearing from NVIDIA this week. It's apt to have a bit of a market-moving opportunity. I think most traders expect when we hear from NVIDIA, we get headline commentary out of Jensen Huang, and that helps the market one way or the other, at least gives a little bit of clarity on the market a little bit. And we know the importance of NVIDIA as it relates to the broad markets. But I think as it relates to the S&P, there's not a lot more that we can say that we haven't already been saying for the better part of the last 8+ weeks, and that is to watch the same levels we've kind of been keeping an eye on here. So 67.75 approximately to the downside, and we know 7,000 to the upside. That 200-point range approximately that we've been stuck in. And again, as traders, we can expect one move or another. It's not recommended that we position ourselves in advance of either move. We don't know if a breakout is coming through 7,000 or if a breakdown through 67.75 is coming. So, Jeff, I think a lot of traders are just going to maybe take the approach that says, show me which direction you lean, market, and then I will follow suit thereafter.
I think you hit the nail right on the head, big guy. One of the things that we discover at some point in time for all of us, and let's be honest here with ourselves, to the viewers and everybody in the room right now, at some point we get antsy, we get impatient, and we start saying, well, I haven't traded for X period of time. Fill in whatever that blank is for you. And what do? We start lowering the threshold of the trades we take on, trying to force something to happen. So be careful in these situations, everybody. It's very, very tempting to say, well, let me get a little bit of a position now before a breakout happens, or let me start to scale back before something goes awry. Be very careful with that. Remember to follow that plan, because ultimately that's what leads to those returns that we're all looking for, Kevin.
Man, that was well stated, sir. I appreciate that as well. Obviously, the market, again, what you just said there about, we tend to lower the threshold when we haven't placed trades. That speaks to the idea that maybe we traders are more tied to the trade action itself than the proper nature of what we're trying to accomplish, right? Stepping into trades where everything lines up. Oh, I'm a buyer at support. The risk reward is in my favor. I have a comfortable amount of cash on hand after I place this trade. Those types of things, if we are running down our checklist and we're finding all of them coming in line, hey, you can feel confident placing your trade. However, if you're finding yourself a little too malleable, if you're changing your process to fit the current market a little bit so that you are more active, even though your checklist isn't giving you as many pros as you need, well, then that is a heads up. That might be a little bit of a red flag. I really appreciate you calling that out, man, because not enough of us are disciplined to what we're trying to accomplish. We can allow human nature to overtake us. So I'm glad that you mentioned it. We're going to move on from the S&P. We're going to move to the NASDAQ. As I do that, I just wanted to touch on one or two comments there in the chat. Yeah, I was one of those individuals who was up bright and early yesterday morning watching Team USA versus Team Canada in the gold medal game. Thought that was fantastic. Congrats, obviously, to the Team USA. Had a lot of fun watching that game. Dragging at the rest of the day yesterday after getting up early for a 6 o'clock face-off, but I thought that was wonderful. We are going to be looking at NVIDIA momentarily. I wanted to lead with the NASDAQ, though, Jeff. Again, when we're looking at the NDX, you can see I've already drawn in some levels here, and I think you probably walk away with the visual that we want, which is, hey, we've still been going sideways here. I'm going to lift this one line, but my horizontal lines in here are pretty evident of the price ranges that we probably need to be keeping a close eye on here. Would you agree?
Yeah, absolutely. A little bit of an early warning sign for the viewers out there. What would give somebody concern, excuse me, Kevin, when good news is bad news? And what I mean by that, everybody, is you've got some earnings coming out so far this season. The beat rate is very high, much higher than historical. I think it's 75% have beaten this earnings season, where the average is about 66. So that's good news. But take a look at this chart, everyone. You've still got your 20 period below the 50 period simple moving average. You still have your price action below both of those levels. This is a bit of a yellow flag moment for some traders out there, where we say, hey, wait a second, why such a good earnings season is not producing increased momentum to the upside on the chart? That's a yellow flag moment. Not yet a red flag, Kevin, but that's something that people are kind of keeping an eye on. If things continue down this trajectory, that's where you say, uh-oh, people are starting to get out a little bit earlier. Overall, though, still probably should be in the third phase of a bull market. Not saying this is what's it's supposed to happen, but historically, when you're seeing earnings like that, that says, hey, there's still more room. Kevin, we'll talk about breadth here in a little bit, but that also gives you a little bit more gumption and gusto to the market movement, and yet we're not seeing it translate into higher highs. yellow flag moment at worst, I would say. I don't know that we're yet in red flag territory right now, Kevin.
Well, the challenge to the Nasdaq, of course, is that you're getting a bifurcated market in technology. We see semiconductors doing well. For example, here I'll just highlight this quickly instead of devoting a lot of time to semis, but you'll see it, everybody. This is very much lower left to upper right. It's pretty clear we are in a scenario whereby semis are dabbling with the potential for a breakout. Now, the NASDAQ 100 doesn't look like that, even though the NASDAQ 100 is very heavily invested in technology and technology specific to semiconductors. These charts look very different. But the other space in the NASDAQ that's causing this consternation, of course, is the software space, which again, today, seeing a bit of a breakdown, Jeff. I thought we were at a spot where maybe we were going to see this group hold up, and it looks now what you may be getting is in fact a legitimate bear flag breakdown, which is certainly less than ideal on a very important space.
Great call out, buddy. Yeah. You still have 10 companies making up 41% of the S&P 500. So that could be where some of the help is coming from. But you're also seeing small caps doing pretty well. But I love this call out right here, Kevin, is you're seeing this almost a full breakdown of this sector. And that is a little bit of a concern. Again, you really like to see the information technologies and the consumer discretions crushing it as we're going into a further elongation of a bull market. I got a chat question, third phase of how many? It's usually about four phases when you're talking about the bull and bear cycle.
So, Jeff, knowing what we do about the NASDAQ specifically, the component breakdown, which we talked about last week a bit, you all who are here frequently, you saw as we looked at the heat map, you see the discrepancy between the number of groups exposed to the NASDAQ 100, right? A very limited scope relative to what you get in the SPX with your utilities and real estate and so forth that you don't get in the NASDAQ 100. But the sideways here, really, the reminder that I offer up is the idea that we can still be going sideways in the NASDAQ, and that's okay. The truth of the matter is, while we've not broken down, the fact that the reason we've gone sideways probably, Jeff, has as much to do with the fact that we've made a strong push as anything else. I mean, again, that was a 57% up move, and that up move required some digestion. It happened very quickly over the course of 6 months, and now we've managed to have essentially gone sideways for all of November, December, January, and nearly the entirety of February. So what have you seen? Essentially a 4-month consolidation, digesting the immense pop we got. So we could absolutely validate this as nothing more than allowing time to pass, allowing our moving averages to catch up to the trend and price levels, and let's see how we act. Because now that we've got, notice the 200-day, Jeff, caught up to horizontal support, the last lows we made in November, I think that presents as an important level with confluence of support for bulls to expect or hope to see the NASDAQ hold up. Obviously, under that level is maybe a spot where traders need to take action at some point.
Really good call out. That's something everybody's eyeing up. Be careful, everybody. Don't jump into this too soon. Some folks will say, all right, now's the time that we short the market. And remember, it requires a margin account to short the market. It's a higher level of risk. But they go, I'll short the market now. I'll get ahead of it. And then when it drops down to that level, I'll close out my short and I'll make money from where I sold down to where I bought, almost the reverse of buy low, sell high. If you do that, if you take that approach, you do risk that it doesn't come back down to that level and the bull market continues and we pop above 20 and above 50. And then, maybe you have yourself a short squeeze situation, which any of you have been in. That it is not a great time, Kevin.
It stinks when you're on the opposite end of it. You're correct. Yeah, it's not exactly a fun window.
It just zooms right up and you go,
not
what
exactly. No, it's terrible. If we looked at these on these longer range charts, everyone, you're going to see at K Brown's request here, you're going to see a lot of the same stuff. If we're looking for trend analysis, longer run, look at that 20-week moving average, Jeff, in this light blue. That's been held for all but that tariff tantrum that we got in late March into April, or March into the April bottom. We got corrected, quickly got back above the 20-week, Jeff, and then it was trending from there forward, right? I mean, basically telling traders, hey, under the 20-week, we need to be cautious. As long as we hold the 20-week, maybe there's more of a comfort and a tolerance for risk.
Yeah, and that level, this is why it's so important to the viewers out there. You've got to look at different time frames. A lot of us focus in on like a 1-year daily chart most of the time. You've got to go to different areas. Is there something happening on a longer term chart like Kevin is showing right now that I should be aware of? And I think most certainly this is a really good call out to keep in mind as you're looking at those potential support levels, Kevin.
All right, Jeff, let's move and hit up the Russell. Before we do, we're going to comment and agree with Carol, who states that Jeff is one snappy dresser. She is not wrong. Jeff is about as well-dressed a gentleman as you're going to come across, everybody. And this is just every day, by the way. This guy knows how to put himself together. Let me tell you, it's a good look, real good look. Jeff, talk to me about what's going on in the Russell here, man.
Well, the Russell is one that I think a lot of people are keeping an eye on because we're a little bit surprised going back a few months that the Russell was continuing to go higher. We said, wait a second, you've got rates still staying stubbornly high despite some of the pullbacks in the Fed's interest rate. That would lead some people to say, wait, this sector just shouldn't be doing that good. But in fact, Kevin, it is doing pretty good still. A little bit of a sideways movement, maybe even forming into a wedge right here. Let's see if we can continue to hold that 20 period or if we break below it. But overall, this speaks to what I was talking about earlier, everyone. The breadth of the market. That's what you want to see when you're in a bull market cycle. You want to see the breadth continue. What you would like to not see happen is, it's two companies that are pushing all of this and everybody's getting left behind. So the fact that we're seeing the Russell still continuing to move positively, that is probably a good thing for the bulls out there, Kevin. I want to touch on something real quick before I throw it to you on your insights.
Yeah.
So for the question about the phases of the economic cycle, 1 is recovery, 2 is expansion, 3 is slowdown, 4 is recession. So this is more the slowdown, the topping out point. What you generally see in the slowdown phase, the sectors that are doing better, consumer staples, energy, healthcare, materials, and information technology. So keep an eye out for those. Just wanted to get that out there to the viewers. Yeah.
Sounds quite familiar, to be honest, doesn't it? Jeff, you're right. We're going to look at all of that 1 second. Before we do, I'm just going to apply everything you stated is on the money in my view as well. So you're going to get a lot of continuation or similar viewpoint from me. Ultimately here, it's been the 50-day moving average. As you can see, everyone grabbed that back in late November, Test 1, test 2. As long as we've maintained the 50-day once more on even a pullback to the 50 is going to be fine for traders, because you're going to be, if the selling at the 50-day ceases, well, then you can say we've made another higher low. We've held support along the 50-day moving average, dynamic trend line, etc. That's why the 50-day is an important level. That comes in about 2608 right now. We'll see if that holds. Now, yields, as you called out, Jeff, yields have fallen pretty dramatically over the last 3 weeks here. Now, we've moved from basically 4.3 back down under 4.06, as you can see here. And, Jeff, this seems to be giving us a little bit of comfort for the Russell and the small caps in general, but still, it's not led to the breakout just yet, right? So small caps consolidating a little bit, could be waiting for that break to the upside here. Any thoughts on yields specifically?
Well, we're looking back to the support levels that we saw at the early part of the winter. So it's kind of more of the same situation, similar to the toppiness that we're seeing in the S&P 500 and the NASDAQ. It's not saying that anything major has happened. It's almost like a wait and see situation. So what are people going to be looking for? Do we break below those levels? Does the Fed continue to lower interest rates? Can we see this drop somewhere in the 3s? I think that, Kevin, might signal to everybody, oh, wait a second, something new is now happening. But even this movement, as dramatic as it's been over these last couple of weeks, I don't know that it's just to a lot of investors. And I'm speaking specifically to investors, not so much the traders, but the people going long term. I don't know that it's changed their view all that much. Get down into the 3s and you might have yourself a different situation, Kevin.
Yeah, I think under 4% would be a significant development. You can see we've been down there before, everybody, but we've not been down there for long. So instances in that area have been few. since the recent move off of the 0% rates we had for so long. So under 4 again would be a very significant development in the way of expectations. Everybody, according to the CME Fed tool, going into the summer, we have to get out to June before we even see a likelihood of more than 40% for a rate cut, according to how traders are currently positioned, and that used to be higher than 50%, but we'll see. I mean, we'll continue to bring that to the table here in this class, as you all know. So just a little bit of a heads up. Jeff, let's talk about some of the sector stuff going on here. We are witnessing the VIX climbing a little bit. We were up about 5% in the VIX off the open. The S&P is kind of hanging out, but not selling down aggressively. But we're getting a little bit of lift here. Jeff, I think some of the lift in the VIX is twofold. Obviously, the tensions in the Middle East, along with Nvidia's report later this week, certainly giving traders reasons for being a little bit defensive. And we need to be reminded of what the VIX represents for us, don't we? I mean, it's positioning of SPX put options, of course. So this is telling us traders are feeling maybe a little bit, uncomfortable. Jeff, I can bring that also with a quick view of what's going on with oil, which is also talking about Middle East tensions a little bit. So you've got oil spiking a little bit. You've got the VIX spiking a little bit. What else do we need to be thinking about here?
I think both of those things are important. You've got gold, normally seen as a safe haven. That one's doing a little bit better this morning as well. So what is that telling you? Well, people are a little bit afraid right now. Again, going back to the comment I made earlier, Kevin, I don't know that that translates into a full-out sell everything right now moment. I think it's more of a reactionary movement as opposed to a revolutionary movement. So what are you going to be looking for? Does this quiet down throughout the week, or do we continue to ascend for something like the VIX or even like an oil? If you don't see that ascension, trades back on, everything is normal. We'll see what happens. Maybe another tweet changes our life for whatever reason that's worth. What else you might want to keep an eye on, though, here as it relates to oil? Keep in mind, OPEC is the big mover when it comes to oil. So for those of you traders out there that are in that space, a lot of what you're probably going to be looking for this week is, what does OPEC say? Are they going to cut? Are they going to continue to let a flow out? That can be very impactful, as opposed to, I don't know that what's happening with Iran right now is saying, oh, this is completely changing the shape of the oil market. Remember, the biggest exporter of oil right now is the United States. Okay. I don't know that anything with Iran is going to change dramatically how much oil we're going to put out into the world. So watch out for OPEC announcements, maybe a little bit more than what you're seeing in the conflict in the Middle East. Just a thought there, Kevin.
Okay, excellent stuff as always, Jeff. Let's kick this from oil briefly and over to energy. And I should mention, by the way, we're looking at a future product here on the oil price. And I should also at least point out that futures option trading, of course, this involves substantial risk. This is a different approach to everything else that we discuss in this class. So make sure you're familiar with the risk disclosure statement for both futures and options if you're interested in trading futures contracts specifically. Jeff, it is having a little bit of an impact here in energy, which just continues to do what it's doing. In fact, if I go to that Market Watch tab and bring us back to the quotes page, as you called out that late cycle leadership, you could be pretty well, I mean, you may as well have just been calling on the names at the top of our year-to-date returns. I mean, staples, industrials, materials, energy, all of those four above a return beyond 10% year-to-date in only week 7.
We get lucky sometimes, Kevin, as I like to say. The energy sector is doing really great. Sometimes it just happens live in front of viewers, which is wonderful. But yeah, the energy sector doing well, I think, is another callback to what's happening in the oil sector, because that's a big mover when it comes to the energy space. What are people going to be looking for? I don't know that 50 period at the bottom is what their attention is going to be on. I would say that 20 period, or I call it, you nailed it, Kevin. That 10 period might be where everybody's eyes are going to. Why? You've got this almost parabolic lift in the energy space. When you have that fast movement right there, the 20 seems to lag a little bit too far, but the 10 kind of catches up with everything that's going on. So what would you be looking for if you're saying a new conversation is starting to happen in energy and a bearish movement might come about? Watch out for that 10-period simple moving average. That may be the one that traders are looking for as a break below, Kevin.
Yeah, Jeff. And again, we're not saying that we know what's happening next, but from a trader's viewpoint and a technical analysis viewpoint, you've been working with that 10-day moving average to the upside. Each very limited and brief retreat to the 10-day has brought in buyers. There's been interest and desire to expose more money. When that changes, the price is apt to pull back a bit, and that's why a trader would wait for a close perhaps below the 10-day as that first signal of that breather coming. How the trader chooses to sell, how much they choose to sell, obviously that's trader's choice, right? Each of us are very different in how we approach our process. But for some of you, on weakness, that first close under the 10-day would be sufficient to take a percentage of your position off the table. For others, it might be the 20-day because you're saying things like, well, I've ridden the 20 for a while. That's my time frame. I'm more comfortable there. Or I like that horizontal support approximation. I prefer that. And I'm comfortable with the difference between current price and that exit strategy. So as long as all those things line up for you, work with the process that makes sense for you and your approach to trading. That's the key. We always remind ourselves, we as traders are exceedingly different from one to another. So have your plan, try to stick to it as best we can.
Hey, Kevin, question for you about it. I'm curious, because this is something that I get client questions about all the time when I'm in the branch. All right, I'm in this trade. I see what's happening with energy. You have that 10-period simple moving average up there. What percent of my focus should be on what happens in the news versus what happens on the chart? Any insights for somebody that's still trying to parse and parcel through that?
I think I honestly no, because what it amounts to is not a what happens is that we traders are looking for definitives. You're not going to get definitives from the market. Okay, you should probably, if you're looking for definitives, 100% or guarantees this works every time, the market's not for you. Okay, the market doesn't give us that, but it does give us a way to manage things. And a lot of that time, everyone, it's not managed so much on, am I right about selling here or buying here? It's, am I at least not more wrong than I should be? And that means, am I not investing too many dollars here? I'm investing an amount that if I'm wrong and I can admit I'm wrong, well, then I'm going to sell when I'm proven wrong. And conversely, if I'm long and invested in something like the energy sector here and price continues to move higher, I have to set a level under which I no longer have comfort for the amount of dollars I have invested. We can, Jeff, 20 years, 30 years, 40 years watching the market, the thing that matters more than anything else is your own emotional tie to your trade. If you can reduce emotions along the way, such that you're making decisions that are black and white, yes and no, black, white, nothing that involves your emotional tie to your trade, odds are you're going to be a better investor and a better trader for it.
Love that.
What do you think about that?
Insight. I love that. Phenomenal insights. Thank you very much. Very helpful.
All right, Jeff, let's talk about some of these groups that aren't holding up today. We're going to check on quickly. We'll hit industrials. We've been watching the 20-day. It's actually doing just fine. I'm going to pull all my moving averages back in there. The reason we're watching the 20 is pretty self-evident here, I think. We got above it back in the fall or late December, I should say, early December, and we've been riding that one. So that's hanging in there, even though we're off about a 1% move there today. The discretionary space, however, Jeff, we've made a pretty good pullback to an area that many traders are suggesting needs to offer support. We're kind of hanging out at the 200-day, but this is getting a little precarious on a discretionary space.
Yeah, again, going back to the idea that we're in the third phase, expansion, the second phase is where you see consumer discretion really holding up. And now it's starting to pull back a little bit, so turning into a bit of a lagger. But Kevin, you hit the nail right on the head, my friend. That 200-day, it's just a what are we going to do type of moment. Do we go above? Do we stay below? What exactly is going to happen? Right now, it looks like 1, 2, 3 or 4, 5 different times we've gone below it. But I wouldn't say let's count that out, because you could still have it come back up and say, all right, now we're just going to bump along this for the rest of the early part of the year, maybe throughout the spring. ultimately, time will tell what exactly happens with that. But yeah, that 200 period, I would be surprised if a lot of folks trading this space aren't laser focused on that number.
Yeah, I think so too. You know, I'm going to use this as an opportunity to answer a question here. Somebody,
Sure.
CM, is mentioning that nobody mentions the Horner rule any longer. It still applies. Remember, the Horner rule simply states that you need to define confirmation. Let's use discretionary here, Jeff. You know, we have been below the 200-day movement. I'm going to zoom in here. We're basically, so we got this sell off, right? And we got ourselves a weak open followed by a strong finish on this big, beautiful green candle day. And then the next couple of days, we had closes above the 200 day. So it looks like what you had was a support test. And yet, day one holding the 200, day two, day three, day four, day five, you're back below the 200. And so if we were incorporating something like the Horner rule here that says, are we holding support? The question becomes two things. One, is support considered to be the 200-day moving average in blue? Or is the trader saying, no, I'm going to call it more like a horizontal level like this? You know, what a lot of traders would say is we need to define that level and we need to get back above the trend. And if it was the 200-day moving average, what a trader might be looking for is, say, 2 consecutive closes, maybe 3, maybe 4, maybe 5 consecutive closes over the moving average. And I say that, Jeff, because you got 3 or 4 in a row here and it still went lower thereafter. So I think it's maybe not brought up as frequently, but the reminder needs to be same thing. Traders, know what you deem to be confirmatory in nature for you to take your trades, and then try and stick to that concept as much as possible, Jeff.
Yeah, I love that. And be careful too, because if you start to say, well, I look for 3 or 4 days, it's very easy to say, well, 2 is close to 3, so I'll do 2. Or you go, 5 is close to 4, so I'll do 5. You get that confirmation bias, everyone. Watch out for that. Make sure you follow the rules. And as I like to say, Kevin, make it easy enough that you could write down your trading rules on a piece of paper, 8 by 11, hand it to a 12-year-old, and they are able to implement this. They know what they're looking for their buy signal, for their sell signal. They're looking for the setups. They're able to filter out through the all the mechanisms in the market what exactly you're going to trade. If you can't keep it that simple, maybe try to get a little bit closer to something that's less opaque, because if you have a bunch of rules and it has to be this, but also if the sun seems to be kind of a little high in the sky, don't do that. Make it super, super easy. That way you can continue to follow it, Kevin.
I totally agree. You nailed it, man. I also liken it to the elevator speech. If you can't explain your trade concept for the majority of your trades, every once in a while we all have a little bit of maybe a little excitement or enthusiasm for a trade that doesn't always fit our strategy. And that can be fine as long as we keep them small. But ultimately, what you're saying is your process needs to be relatively simple, easily repeatable, and if you can explain it in the course of an elevator ride to the guy you're on in there with, then you're probably doing a decent job of keeping it simple, right? So I like that approach too. Okay, let's move on down our sectors here, Jeff. Let's see what else. We got Staples in the leadership position today. From a trend standpoint, Jeff, that looks like you might be getting a hold today. If this candle sticks for the day, then we might call the low we made on Friday our low in the pullback. And you'll notice that all of that coincides with the rising 20-day moving average. So some confluence of support here as well.
I like it. Kevin, remind me again, what is a hold for the viewers that haven't heard of that term before?
Yes, hold. It is an acronym, everybody. Close above the high of the low day. And we do look for closes. So this is too early. We would call this right now a hold, a trade above the high of the low day. And some traders would be aggressive, admittedly, would be looking at this candle and say, all right, it's only the first 35 minutes of the day, but that looks like a good start, and they might step into a trade right there. Of course, the encouragement in doing so with a trade above the high as opposed to a close above the high might be to go small, because you're taking a bit of a risk here, right, Jeff?
Mm-hmm. Yeah. Gosh, a little bit early in the day to see what's going to happen here. Exactly. But okay, so that's a hold. So you're potentially looking for more bullishness. I would assume if somebody is looking at this chart, they go, wait a second, that 1,000 level is eyeing me up. we bonked our heads against that not too long ago. That could be
Yep.
where this trade possibly goes to. Is that the idea here?
That's the idea. And the idea,
Okay.
well, essentially getting a new high followed by a pullback to support, followed by the first step, the hold move. If you get it, that's the first potential indication that the trend can continue, right?
Gotcha.
And so
Okay,
if the
cool.
trend is going to continue, Jeff, well, then we might expect perhaps a breather as we reach resistance. And if we can push through resistance, well, then we are maybe going to monitor the trend using the same 20-day moving average we've been using all along, right?
I love it.
So
Excellent
one
setup.
more way of thinking about it. But again, I think the encouragement when you're thinking about it in this way, Jeff, is that there's a way to step into these trades with a plan, and doing so maybe not whole cloth, so to speak, right? Not 100% of the trade on every instance, right? Some traders, for comfort, they start small, maybe 25% of what you want. Maybe it's a 3-tiered approach. Consistency is still key, but if the 3-tier approach is your preference, 25% on a close above the high of the low day, maybe another 25% as you close at a new high, and then maybe another 25 or 50% later on a new high or on a pullback to support. Whenever, again, you just need to have these ideas laid out for yourself. Hopefully it makes it easier in your planning. Jeff, the interesting movement we see here, I think of late, has been tied to these really two groups that we generally don't hear from. Look at utilities.
Yeah, right. Utilities, what
Utilities
is that
pushing
all
back to
about?
highs, and real estate pushing to highs as well. So
Yeah.
interestingly, now of course these are both tied directly to what's happening in the interest rate environment, and we talked a little bit about the yields retreating. So this is certainly benefiting those two.
Yeah, most certainly. And I remember going back all the way to last year when we saw this increase from September to roughly mid-October, and you just go, is this the utility sector or the information technology space that I'm looking at here? What is happening? So you got that big run up, came back down. We've hit our head against that one other time. Now, what people might be looking for is, can we come up above that? And if you're holding utility companies, Kevin, the other nice thing is not only do you have this capital appreciation, you might also have yourself a couple of dividends in there somewhere. So really good returns for those who have been in this trade. Same thing with the real estate space. You get a lot of real estate momentum coming not by way of individual home sales, but by the institutions that hold apartments and think big real estate environments. Manhattan, you've got a lot of those in there. So those REITs you can see in that space as well. But yeah, the interest rate story, I think, is what's dominating these big movements right here, Kevin, and you called that out perfectly. So what might you be looking for? Well, if interest rates are no longer softening, that could give a little bit of pause for this movement. Otherwise, if it's continued to work, it may continue to keep working, Kevin.
That's true. We don't know how long it can go. And when you look at this chart, Jeff, it's not technology, like you said, but nonetheless, you broke the downtrend line. Notice the speedy 20-day moving average with a very quick move to the upside here. Maybe it was this candle that was when traders got a little bit more comfortable right here. And yet, traders would have been, oh, it's utilities. Why would I step into utilities? That's not excitable. But if you bought based on the broken downtrend, even if you bought the high at this day, you could still be up 5% in a space that you wouldn't expect to rally 5% over 7, 8, 9 sessions. So the reminder is technicals can work. And if you have a plan and you adhere to it, the next potential opportunity for utilities is a break to new all-time highs, Jeff. And that would be notable, very notable as it turns out. So you could see it on the chart here as well, can't you? So lots of similarities here we have to be aware of. But more than anything, I think the takeaway is the market changes. The market gives us opportunities. Don't swim upstream in groups that aren't working, right? That's why we say things like fishing in a well-stocked pond is one of the things that a lot of traders strive to do, Jeff. They're not necessarily looking right now at technology and discretionary because they've been struggling. Where are they leading? Energy and materials and staples. These are the groups that are trending right now, Jeff.
Yeah, one of the calls out, if we could look at that, excuse me, that chart of utilities again, Kevin.
Yeah.
Take a look at this, everybody. Let me grab your attention for just a moment. Watch the volume. You notice that volume as we're going up green. look at the increasing volume. That's saying, yes, we are in favor of this. We like what's happening. As we topped ourselves out and started pulling back down, those 2 red down days, they weren't on increasing volume, everybody. The volume was decreasing on the down day, letting you know that there maybe is more bullish sentiment. So when you have that turnaround, and now we're coming up to that potential resistance spot, that was more of a signal well ahead of time if you would have kept your eye on the volume. So as we like to say, Kevin, make sure you're looking at that confirmation mechanism that is volume, because it can give you early warning signs of, yes, we have a convergence of what's happening, in this case, the bull movement, or we have a divergence of what's happening, in this case, that short, brief bear movement.
Excellent comment, Jeff. Thank you. Guys, we have a survey opportunity in the chat that came to us late in the session here. It looks like Brent has reposted that a couple of times. We, of course, very much value your feedback and opinions, everyone. If you'd be kind enough to click that link and give us your thoughts, we would greatly appreciate that. Jeff, we need to get to a couple of other things here. One, quickly, we talked futures a little bit ago, so I'll just remind you, we're going to look at 2 futures symbols here. We're going to quickly look at silver and gold. Whoops, let me get my clicks correct here. So here's the future symbol on silver, which doesn't look like it's right back on trend just yet, does it, Jeff? With the 20-day moving average right here, a little bit of work from silver that's necessary still.
Yeah, you got that 20-period resistance, and this will be the go, no-go type of conversation. So what plays out the rest of this week could be what determines if we get a break up or a breakdown, Kevin.
Exactly. And now gold, as you called out a little bit ago, this uncertainty of the market, this concern as it relates to the Middle East, maybe some concern as it relates to Mexico, things are just a little less comfortable, and shouldn't probably be all that shocked to see that gold has gotten itself back in gear a little more quickly than silver.
Held that 20 period, still moving further north. I think obviously the level of resistance that people are going to be paying attention to, if we can continue going further up, 5,500. Yeah, Kevin called it out perfectly right there. Don't think of it like a magnet, though, everybody. Just because it's a level that you previously hit does not mean you have to go back to it. That's a mistake I made early on, is thinking of support and resistance as magnets, which they are not. I wouldn't be surprised if as the week unfolds, some of the uncertainty starts to get deflated out of that balloon, and it says, well, all right, maybe we don't need gold as much as we thought, and then it ends up not hitting that 5,500 level. Ultimately, time will tell, Kevin, so we'll just have to see what happens.
Certainly possible here. Notice the difference between, say, the 20-day moving average, which has been violated on more than a few occasions, versus the 50-day. One of those has been a lot more solid and a bit more confirmatory in nature, and the other, the 20, doesn't quite seem as solid. And so you can find yourself working with the 20-day and maybe getting a stopped out trade, whereas with the 50-day, getting stopped out, it may mean a little bit more likelihood of the stock or the group, in this case, the silver, gold, actually going lower on a close under the 50-day. That would be a significant development since we haven't seen it. Jeff, we also teased the move in NVIDIA. NVIDIA actually got an upgrade today. I'm going to bring this up briefly, and we'll talk about the expectation for a move here. But they were upgraded at Alethea to buy from hold with a 250 price target. The stock finished at about 192 on Friday. The firm Alethea sees compute spending rising 75% year over year, suggesting that NVIDIA and the processing unit supply chains continue to capture the lion's share of value in this space. So suggesting it's too cheap to ignore. That's the reason for their upgrade here, regardless of what we've seen from price. And Jeff, really, NVIDIA's been going sideways for a lot of this most recent window here. Notice how that flat of that 50-day moving average is. But I thought we should also give a little look at the expectation for the market maker move based on this earnings report coming. So let's just quickly pull up this week. Look at that, Jeff. Looks like we've got our midweek options available finally. So if we go out to the end of this week, that'll be the 27th, and you can see there about $12 move at this point. That is the Friday, correct, Jeff?
Yeah, I believe so. Yep, 23rd.
So we're looking at about a $12 move plus or minus. So either direction, 12 points right here based on expectations.
Yeah. So again, it doesn't say it's 12% to the positive or to the negative. I've had clients that look at that and they go like, "Oh, well, look at that." So it's $12 to the positive. Well, wait a second there, professor. This is saying plus or minus. There's a little minus sign below there, even though it's hard for my eyes to see it. It's the expected move to the positive or to the negative, similar to the average true range. It's not saying it's a positive or a negative movement, but it could go either direction.
Yeah, it's a measure of the volatility expected, and it's a little shocking. Maybe we'll see that climb a little, Jeff. It's only about a 6% expected move, which is a little low for NVIDIA, but maybe that's because, the stock isn't trending. The stock is going sideways. We got the 20 and the 50-day moving averages kind of flat. We've been doing this kind of maneuver for a while. And again, part of that is the strength of the up move, right? You had 145% move to the upside. We probably shouldn't be surprised that we've gone sideways for a few months thereafter. We can't continue to rise 150% over 6 months without some digestion occurring.
Even a marathon runner needs to stop to take a drink of water, Kevin.
It's the truth, Jeff. That's the truth. Hey, Jeff, let's remind everybody this week in particular, Jeff and I will be getting together out in the San Diego area. In fact, we'll be out for the Market Drive event in San Diego on Saturday, but I'm coming out Thursday, and Jeff and I will be going out to the branches in the San Diego area. We're going to have a little discussion, kind of treating it like a little bit of trader talk, aren't we, in the branch coming up this week?
Very much looking forward to being in person again, Kevin. Can't wait. We're going to have a lot of fun over those 3 days.
I'm looking forward to it as well. Hey, I want to thank you all for being here today. I know the market's been a little bit choppy, to say the least, but I hope you all are maybe a little bit more prepared for what this week may bring. Continue to please follow Brent and me on X, Brent Moores CS, Kevin Horner CS, and hit that survey if you'd like. We'd love to hear from you. All of your comments come to me directly, so they are very well appreciated here, and I'll be happy to read them. And again, make sure that you're keeping it tuned to the Schwab YouTube channel here. More from us all day today. So last note, hit that thumbs up if you like the conversation. We'll get this reviewed for you. It'll be in the archive a little bit later today. And with that, hope you all have a fantastic Monday, everybody. We look forward to catching up with you again real soon.